Okay, I'm going to talk about chapter 12. So this is about the risk, return, and the financial markets. Okay, so the major topics would be that we want to understand the financial market. We want to know what would be the appropriate returns on non-financial assets. And then we can learn from the history how the capital market performs in the history. The major lessons we can learn is that so no pain, no gain, right? So if you want to have a reward, you have to take the risk, okay, for the investment. So that's why that's a difference between a boss and the employee, right? So employee does not take any risk. Employee only take a paycheck, right, on a monthly, bi-weekly basis, right? The boss has no guaranteed income, right? The boss has to run the business. Hopefully, the business is successful. He has lots of bills to pay. Hopefully, at the end of the day, after paying all the expenses, he would have income. And hopefully, his income is higher, right? Because he's taking all these risks, right? So when you bear risk, there is a reward, okay? Actually, the greater the risk, the potential reward is, right? So they are correlated. More risk, more reward, right? You can say it the other way. If you see more reward, and the risk is higher. So let's use a very extreme example. If you want to win the lottery ticket, right? The jackpot is about like $70 million. That's a great potential reward, right? It would be really nice, right? If someone win like $70 million, right? So you are set for financially, right? If you are wise. Okay, there are a lot of stories about lottery winners. Um, you know, they squandered all their money in 10 years. And then whatever after that, they have an even sad life, right? So the idea is if you think about the lottery ticket, right? The reward, the potential reward is very great. It's huge, right? But the risk is very high. So you almost guaranteed to lose the $5 you spend, right? So the risk is very high as well. So the greater the reward, the risk is greater. We call this risk and return trade-off. Okay, so never believe anyone try to convince you that they have a great product that promise like huge return, but you are not taking too much risk. That doesn't exist, right? So you have learned this finance course, right? So um, more reward is related to more risk. Okay, so if people promise you high return, but try to downplay the risk side, right? That's not fair. And depending on your own profile, risk profile, some people like risk, right? Some people was like, I was thinking about those people who are going crazy, like high speed on the highway, right? They enjoy that kind of stimuli, right? When they are going like 200 kilometers an hour on highway, there's a lot of risk, right? They can have a car accident, but that really makes them excited, right? For other people, they drive really slow, right? Always on speed. So there are people who are risk loving and risk averse, right? All risk neutral, right? People who are saying, yeah, I don't like stock market, too much risk for me. I'm just happy to save my money in the bank account, right? To earn a little bit of interest. And, well, that's fine because, right, that's just you, right? So you are fine with no risk, but no reward, right? Just a little bit of money that probably will anti the inflation, right? But nothing extra on top of it. So, so we're going to talk about returns in general, and then we're going to examine the historical data to see what we learn from that. The first thing we can learn is about what is the average return, okay, for different non-financial assets, stock, bond, right? What is the variability of the returns, right? So average return is just like a number, average, right? But what is the variability? That means how spread that non-financial assets return over history, right? Sometimes it's high, it goes really high, and sometimes it goes really low. That would be like a wide spread representing great variability, right? And so that's the second lesson. And actually, the variability is actually related to the risk, okay? And then we're gonna learn there are two ways to calculate the average return, okay? Arithmetic versus geometry. Last, we're gonna talk about the efficiencies in the capital market. Okay, when we think about the returns, if we particularly think about in the dollar amount, this is what you get. So as a property, you may earn income from it, right? So if it's a stock investment, you get a dividend. Depending on investment, some stock does not promise any dividend, right? But let's say they promise you dividend, right? When you are holding the investment. If you buy the bond product, right, they promise you interest income, right? So this would be all the income you are going to earn while you are holding the investment. So that would be part of your dollar return. And eventually you will dispose this investment, right? And the proceeds versus your cost, the difference, right, would be your capital gain, right, or loss if you lose money, right? So so there are two ways to think about it. One is income, the other one is capital. So here's the one example. You bought a bond for $950 1 year ago. You have received two coupons of $30 each. You can sell the bond for $975 today. What is your total dollar return? Well, the income, each year you get $30 income. So this is a bond, this will be your interest income. And for 2 years, so that's the $60, right? Interest income. What about the capital gain? Well, the proceed of the sales is $975. $975, okay? And the cost, the purchase price is $950. So $975 minus $950, so that's $25 capital gain. So in total, your total dollar return would be $60 from the income plus a $25 capital gain. In total, your total dollar return is $85. Okay, so if you have taken the personal finance course, you should have done some calculations like this. You should know this very well. Okay. Percentage returns. Okay, so we just talked about how to calculate the returns in dollar amount, right? But generally more intuitive. We are thinking this in terms of percentage, right? When we talk about returns, normally we think in percentage return. Okay, so one terminology is the dividend yield. So that would be the income divided by the beginning price. And the capital gain yield, so that's the ending price minus beginning price divided by the beginning price. So this would be the capital gain. Your total return in percentage equals dividend yield plus capital gain yield. So let me give you one example. If you bought a stock for $35 and you received a dividend of $1.25, the stock is now selling for $40, okay? Okay, so what is your dollar return your dollar return include this dividend, $1.25, plus the capital gain, which is calculated by the difference between selling price 40 and purchasing price 35. So in total, your total dollar return is $6.25. And now let's take a look at this from the percentage-wise. What is your percentage return? Okay, so let's take a look at the dividend. Dividend yield equals income, $1.25, divided by beginning price, $35. So that's 3.57%. Capital gain yield. What is your capital gain yield? Oh, so that would be the capital gain, the $5 divided by $35, the beginning price. So that's 14.29%. Your total percentage return, you add these two numbers together, that's the $17.86. Okay. You can also do this directly by dollar return, $6.25 divided by the beginning price. You should get 17.86%. Okay, so this should be pretty straightforward. Okay, now let's move on to the historical record. Okay, the first thing we want to talk about why financial market even exists, why it is important for people, right? So basically, this market, okay, is a market of funding, right? So it's really facilitate the utility of the use of this money, right? So it could be company, government, or individuals. They have money, they have fundings, right? So of course, maybe students doesn't have extra fundings for investment, but there are people who have extra money on side that they do not need it right away. Okay, so we can call them savers, right? So they don't need to use the money directly right away. So therefore, they want to defer this consumption. Okay, so they use that money to earn a return, right? To compensate them for deferring their consumption, right? So I love Chinese restaurant. Okay, so if I go there, a family of 5, I have 3 kids. We go there every time. We at least spend probably $150. Probably, it's very expensive nowadays, right? The food price has gone up quite a bit. So suppose that okay, so I decide okay, I'm not gonna go there. Okay, I'm gonna defer the pleasure of having a nice meal in a Chinese restaurant. So I could do is I could save that money on site, right? So $150. If I invest it on something, I will earn the return, right? So if I $150, let's say I have 10% return, next year is gonna be $165. So I earned $15 extra, right? So the idea is, if I defer my consumption, okay, if I invest it, I'm compensated, right, by deferring my pleasure, enjoyment of those kind of pleasure. So you also have borrowers, right? People who have brilliant ideas. They need a lot of capital to initiate their plan, right? Business entrepreneurs, even companies, when they're existing companies, they are growing their business. They need extra money, and they don't have the money, right? Where are they going to get the money? Those are from the financial market, right? They can issue stocks, issue bonds, right, to raise capital. So then you can see that it's a perfect platform for both saviors and also the borrowers, right? So these provide a channel for them to work with each other, right? So the financial market. The financial market also provide us with information about the returns that are required for various level of risks. Okay, so based on the information from the financial market, we're able to see make the differentiations between the different investment product, and we are able to see their risk level. Okay, so this picture shows that the trend of the investment record. Okay, so the data is between 1957 to 2019. Okay, how many years is that? So that will be 70. Let's say if it's 70 years, 72 years, probably. Okay. Yeah, no. So 47, 43 times, so 62 years, right? 62 years. So this is the record, the data record of 62 years. If you invested, this is the starting point. Imagine this is like a race, okay? Different participants are the different types of investment. You have four athletes here, stocks, okay? You have the blue line, that's the long bonds, okay, long-term bond. And you have the green line, which is the treasury bill. And you also have the red line, that is the CPI, okay? So suppose there are the four athletes, right? So they start running, okay, back in 1957, okay? At that time, they all have $1, okay? And so they want to let the time speaks, right? So after 62 years, now in 2019, and we can see how what's their performance. Stocks, they are able to turn that $1 into $200. So this is the champion, right? So if you invest into stocks, the $1 is gonna grow into $200. And this is up. This is the second is the long-term bond, $121.25, and the treasury bill, $27.87, and the CPI, that's 9.31. So the inflation actually is 10 times, almost 10 times, right, compared to 1957. So that's what this representing, right? Okay, so it's interesting, right? So the green line is a person who doesn't like risk, right? Just save the $1 into the bank, okay? And the stocks investors are the ones who wants risk, right? And so they ended up with more reward. You can see more risk, more reward, okay? So let's take a look at the annual return. So if we do a arithmetic average return, so I'm going to explain what's the arithmetic average return, okay? So if you, consider every year's return, and then you do the sum divided by the number of the years, that's the arithmetic average return. You can take a look at the different investment. Canadian common stocks, not bad, 10%. US is close to 12% in Canadian dollar. Bond, $8.30. Okay, small stocks, $12. And the treasury bill, $5.49. And inflation, on average, over the years is 3.65. But now it's very high, right? Now it's like high five in the range of the 5 or something, right? It's pretty high now. So you can see that, right? The stocks are doing better. So small stocks, 12%, US stocks, 12, Canadian 10, right? And then you see bond is okay, 8%. But this treasury bill is only 5.45. This has no risk, right? Treasury bill does not take any risk. So, okay. So what is the concept of risk premium? Risk premium means because you are taking risk, you should be rewarded, right? So you should get more return. So that is called a risk premium. We consider treasury bill to be risk-free, okay? So there's zero risk premium, okay? So this would set up a baseline, right? This would set up a baseline for investment as a benchmark. So you don't take any risk. This is how much you get, right? Of course, that risk, that level will be low. But if you take risk to buy other risky investment, you would go have higher return. Okay. So how we do the calculation? So you know this arithmetic return. So every product is compared to the treasury bill. Okay. So all these products, all these return numbers will be compared to this number. So because this is considered to be the rate, right? The rate will be risk-free rate, right? This one considered as risk-free rate, right? So if you do this one, for example, so this one, 10.05 minus 5.49, so that will be 4.56, okay? So why you have an extra additional 4.56 return more on top of more than the treasury bill? It's because you take the risk. So that's the risk premium, okay? And of course, more risk, more return, right? More risk, more return. So you can see the highest market, this is the highest investment on this table, the small stocks. So the return is 12.04. And if you do the calculation, you minus 5.49. So that's the 6.55. So this is the highest risk premium corresponding to the highest return, right? So more risk, more return. Okay, so now I'm going to introduce you learned about average, right? But now I'm going to talk about the variance and the standard deviation. So this measures the volatility of the asset returns. So what is the variance? What is the standard deviation? Well, I hope you have taken some stats courses, the business stats courses. You have learned about all these distributions, average, standard deviation, right? Hypothesis test, all those kind of fun stuffs, right? So basically, I'm gonna bring you to this briefly. So if the volatility is higher, the uncertainty is higher, okay? Think about Bitcoin, right? Think about Bitcoin. So Bitcoin would be considered as a very risky investment. The volatility is very high, right? Because it could goes like to 20,000 and then up to over 60,000, right? And then comes down to 30,000. It's like a roller coaster, right? You have the lows, you have the high and low, high, low, right? It's fun. it's very exciting, right? So this would be the volatility, like big swings, right? Widespread, big swings, up and down, up and down. So we would say this as volatility. So that actually measures the uncertainty, right? So that would be the risk, right? So when you buy at a point, you are facing a great uncertainty, right? It could go up to 60, maybe even 100, who knows? But also you could lose like down to 10,000, right? So that is the risk. So you think about the volatility is the price change, right? So it's like the swing, right? The swing. So if you have just a little bit of swing, right? Just a little bit of swing like this. So that would be a low volatility, right? It's not uncertain, but if you go like, ooh, like this, wow, that's considered as a greater uncertainty, right? Okay, so what is the variance calculation? So historical variance is calculated by sum of squared deviation from the mean. So you calculate the mean, which is another word for average in the statistics term, okay, is not people's attitude. You are being mean, right? So, but you calculate that average, and then you calculate how each specific observation is deviate from that difference, and then you square it and you sum them, and you're going to divide it by the number of observations minus 1. So you may wonder why it has to minus 1. Okay, the reason for that is this calculation of mean is actually all this total divided by the number of observations. Because of that calculation, you lost 1 degree of freedom, okay? Because this, now you have the sum, right? The sum is the same. So that's kind of the rigid point. So you lost 1 degree of freedom. So therefore here you have to minus 1, okay? And then what is the standard deviation? So that's the square root of variance. So you calculate variance, you take the square root, you would get the standard deviation. So let's use an example to explain how this is done. Suppose you have 4 observations, year 1. So n equals 4, right? So 4 observations, year 1, year 2, year 3. And each year, you have the actual return. The first year, 15%. Okay, second year, 9%. Third year, 6%. Fourth year, 12%, right? So if you add them together, that will give you 15, 9, 24, plus 6, 30, plus 12, 42, right? 42. Now, we talk about arithmetic average, right? The average here is calculated as the arithmetic, so the normal way of calculating average. So this divided by 4, so the total 0.42 divided by 4, so I get 0.105. So this is my average return. Of course, this is arithmetic. Okay, return. Now I want to see the deviation. The deviation is the actual minus this average, okay? So for example, in this year 1, so to calculate this, I have 0.15 minus 0.105. So I get 0.045, okay? So then I will use this column minus the second column, right? The second column minus the third column. So I'm gonna get this mean, okay? If you add the mean, it should be 0, right? It should be 0. So overall, the mean is not deviate from the mean, right? Okay, so now I need to do the square. Square the deviation. So I'm gonna use this column 4. This is the column 4. So I'm gonna do a square of column 4 here. I'm gonna do a square. So this equals column 5 equals column 4 square. So 0.45 square equals this. Okay, so I'm doing this for all the data. And now and then I get all this number. I need to sum them up. Okay. So the result is 0.0045. Okay. So my variance equals the sum of the squared deviation, right, from the mean. So that's the 0.0045 divided by number of observations, which is 4. But don't forget minus 1, so you lost the freedom. So after you do this, your variance is 0.0015. And now you calculate your standard deviation. Standard deviation is the square root of the variance. So 0.0015 square root, so you get 0.03873. Okay, so this one would be equals 3.873%. Right, so that's my standard deviation. Okay, that is my standard deviation. 3.873%. So this is just one example to show you how this are calculated. Okay. So now let's take a look at the data. So again, we have the same list of the investment. In the middle column, we have the arithmetic average return. We have seen this data before. And this one is new, the standard deviation. So how to do this calculation, I haven't shown you, right? So they did it for us. So it's interesting if you take a look at a small stock, right? And small stock has the highest return. So that's the 12%, right? So we are saying high return, high risk. And high risk means wide spread, greater volatility, higher standard deviation, right? So here you can see, right, 25.4 times, right? So this is higher compared to the other one, right? Compared to the other one. Okay, the only exception is the venture stock, okay? So they have a low return, but their standard deviation is very high. Okay. So in general, if you take a look, the other returns for the stocks, they have a higher standard deviation. Okay. Treasury bill has no risk, and then it has a small volatility, right? So that's a small standard deviation. Okay. Now let's take a look at this normal distribution. Okay, in the stats courses, you have learned about the normal distribution. So in the middle, this is your average, right? This is your average. You can say this is 0. And then one standard deviation. So if you think about in this case, so what is the one standard deviation? This is for large common stocks. So one standard deviation would be 26.47 minus 10.15. 2, 3. Okay. So in this case, for the large common stocks, the standard deviation equals 16.33%. That's the standard deviation. So if you go higher, you have more return. So 15.15 plus 16.33. So then it can go up to 26.47%. Okay. If you go low, right, the swing, if you swing to the left, this is the low return side. So you 10.15 minus that standard deviation, 16.32. So this is gonna be okay. Let's see. Sorry, I should do the other way. So 16.3 minus 6.3 plus 10.15. So that would be 716. So negative 6.17%. Okay. So So if you have use one standard deviation, you could go to the lower return to be negative. You're losing money, negative 6.17%. If you swing to the other side, when things are really good within the one standard deviation, you can get up to 26.47%. And what does this mean in this distribution? Because this is a probability curve, right? So basically, from negative 0.17 to 26.47, in this range, so the chances for the return to fall into the one standard deviation range is actually 68%. Okay, so this is the probability curve, right? So in any year, when your return falls in the range between negative 6.17 to 26.47, in this range, the opportunity, the probability, the chances is 68% to be there. Now, if you think about, this is just one standard deviation, right? But if you stretch it further to two standard deviation, okay, between 20, okay, I'm going to use a different color. If you think about, you stretch to even further to this bigger range, right, with two standard deviation range, you're going to go from negative 22% to positive 42%. So the opportunity, the probability of any year's return fall into the range between negative 22 to positive 42, that chances is 95%. Okay, 95% chance your return will be in that range. Okay. If you go even further, 3 standard deviation from negative 38 to positive 59. So that would cover 95% of the observation. Okay, see how this works, right? So this is why standard deviation measures how spread out this curve is. Is your curve low and flat? If the curve is low flat, it's spreading out very wide. So you have a high standard deviation, greater volatility. If that curve is sharp, high, tall, and narrow, right? So then it doesn't spread out too much, right? In this case, you would have a low standard deviation and low volatility. So this is the Canadian common stocks. So they track of these stocks, and they consider in total we have 62 years, right? So they consider, right, for the years when they fall into different range, they counted how many years so the return will fall into that range, right? So you almost see this is kind of pictured like a normal distribution curve, right? But you're saying, no, actually, it's not really a normal distribution. Well, the reason why is there is only 62 data points, right? The idea for those curves is for large data point, right? For large data point, right? If you have 600 data point, so this curve probably will be more look like normal distribution, right? So it has to be large volume observations, right? There are many different ways of calculating returns, okay, over multiple period of time. The first one is arithmetic average return. I have talked about this, but we are going to focus on geometric average return. So suppose in this scenario, you invested $100 in a stock 5 years ago. Over the last 5 years, the annual returns have been 15%, negative 8%, 12%, 18%, and negative 11%. So this tells me that the volatility is high, right? Because you go some years 15, 18%, and the low can go negative 8, right? So you swing from high positive to negative, right? So negative 8 and 18, right? Those are lowest to the lowest is negative 8, the highest is the 18%, right? So it's quite a spread. So just by this data, my intuition tells me that this is a high risk investment, right? The volatility is high. What is the average annual return? And what is the investment worth today? So when you do the arithmetic average return, you just do the math, easy, right? So you add them up. You add up the 4 years, 5 years together, and you divide it by 5. So the average arithmetic return is 5.2%. So easy. I don't have to say anything about this more. But let's focus on this geometric average return. So you will start with $100. And the first year, 15%. And then starting from year 1 to year 2, you earned negative 8%. And then 12%, 18%, negative 11%. The sequence is very important, okay? When you draw this timeline, you have to make sure that your percentage return really reflecting the different time point. Otherwise, your calculation will be wrong. So what is my future value? Okay, what is the value? 5 years ago is $100. What is the value today? So we can do that. So start 100 at times 1 plus 0.15. So this will give me, I use a different color. So this term gives me the value at the end of year 1. And then for the second year, they lose money. So times 1 minus negative 0.8, 1 minus 0.08, okay? So that's the end of year 2. And then 3 is positive 0.12, and 4 positive 1.8, and then last year negative 0.11. So after I do this calculation, I know at this point my value is 124.44. Okay, so that's my value. So now the question is, what is the average return? So in the personal finance, you have learned this, but let's just revisit. So in this model, suppose every year they make average return. This is the geometric average return, RG. Every year is the same, okay? And I need to achieve 124.44%. So I need to solve what is my average return here. So I start with $100, and I have a growth model. I grow at a rate of RG for 5 years, so power of 5. So 1 plus RG to the power of 5. So that should give me the future value of $124.44. So when I solve RG, I solve it. So my RG is 4.47%. Okay. So my geometric average return is different from arithmetic average return. Okay. So in general, what is the formula? In general, the formula is the return is you first calculate what is the actual future value, okay, and then you take the square root, the root, right, to the power of 1 minus t, and then you minus 1. Okay, so now let's take a look at this table again. You can see this arithmetic and versus geometric, right? So you can see it's interesting here. This geometric is normally lower than the arithmetic, right? So this is greater, 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 greater. So the only, yeah, this is also greater. So it seems like the arithmetic average return is always higher than the geometric average return. Okay. So we are coming to almost the end of the lecture. We are talking about the capital market efficiency. So when we talk about the efficiency, we are asking the question that how effective, efficient the capital market. In the beginning of the lecture, I talked about the purpose of the existence of capital market is to facilitate the use of basically fundings, right? So people who want to take risk, they should be compensated with more money. People who doesn't want to take risk, they should be compensated accordingly, right? More risk, more return. Okay, so if the capital market is efficient, it's true, then your stock price should be fairly priced, right? Given there's a large amount of investors dealing with the information, they should be able to price the stocks in a very fair way, right? So therefore, you should not be able to earn abnormal or excess return. Okay, so if you deposit your money to the treasury bill, right, you only earn like the risk-free rate, right? So it's hard for you to earn the stock rate, right? So so the idea is, if market is efficient, you are not able to take advantage of any loopholes or whatever to make money, to make a lot of money without taking a risk, right? Efficient market do not imply that the investor cannot earn a positive return in the stock market. So if efficient market imply investor cannot make a positive return in the stock market, then stock market will never exist because nobody would want to invest if they don't make a positive return. So you still need to make a positive return, but an efficient market was saying that you make the return corresponding to the risk you are taking. You will not make any additional abnormal return without taking the corresponding risk. Okay. So if this is a picture showing the days relative to announcement, right? So it's interesting, the capital market responding to all the public informations, right? For example, when the World Health Organization, WHO, made an announcement that the global pandemic, right, of COVID-19, on that date, right, how do you think the market will react, right? So on that announcement date, right, in theory, right, all the investors know right away, oh, we have a global pandemic, and right away they're gonna price the investment at a new value, right? If everything is correct, it should be like a step function. All the information will be incorporated in the price, right? But it could be have some kind of overreaction. Some people was overreacted, right? But this is not a good example because this is going up. The pandemic will make your price goes down. So I'm using a different example. So let's say the Microsoft have this the Chat GPT, right? And so that AI is really smart. You guys should try it. They can do a lot of things for you, and did a very good job. So with that information, the market will price maybe Microsoft at a higher price, right? There may be some overreaction. They really see this as a great opportunity, so they may shoot the price to a very high point, higher than necessary, but then they have to have a correction comes down to this level, right? And it could also have delayed reaction. Some people doesn't really react quick enough. So you see the price will go up slowly, right? Go up slowly from the original point to the point where it should be, right? But the theoretical model is the right line, the step function, if the market is efficient. Market efficient means the information will be digested by the market right away and reflected in the price right away, okay? So it's like one time move up to where it should be and stay there until a further information coming up. Okay, but the overreaction will shoot a little bit higher, okay, and then correct it itself. Delayed reaction would be they just take time, right? Take time for slowly moving from one point to the other, okay? This is like elevator, right? This is like shoot up. This is like an elevator. Funny. And this one is like taking stairs, okay? This is like taking stairs. The green line is like taking stairs. And this overreaction is like, so he reached the floor, but he didn't know. So he reached the even higher floor and then comes back. So use that elevator going up as one example. Okay, so the horizontal axis representing the time window, okay? And 0 means the day on which announcement was made, okay? Okay, so what make a market efficient? So why information can be incorporated in the price right away, right? Well, the investors are doing their job, doing research. Whenever there's new information, okay, many people are working, they would analyze this information, and then the trading will reflect this information, right? So if I know that, oh, global pandemic, so right away, I know that I need to sell my stocks. So when you have more people selling the stocks, the price will come down, right? And the price should reflect all available public information, okay? If the investors stop doing the research work, then the stock market will not be efficient. Common misconceptions about efficient market hypothesis is that efficient market do not mean you cannot make money. You can make positive returns. You just cannot make abnormal returns without taking the necessary risk. Okay, so it means that on average, you will earn a return that is appropriate for the risk undertaken. Okay, and there's no bias in the price that can be taken advantage of. Market efficiency will not protect you from wrong choices. Okay, you still have your own work, right? You need to do diversification, right? You don't want to put all your eggs in one basket. Strong form efficiency. If this is a strong efficiency, the price reflects all information, including public and private information. Investors could not earn abnormal returns, regardless of the information they possessed. Doesn't matter what information you have. The price has already reflect all the information, public and private, so you have no information advantage. Empirical evidence indicates that markets are not strong form efficient, and the insiders who possess private information can earn abnormal returns. Okay, so there are a lot of accounting professors doing capital market research. They would analyze this capital market data, and they were finding some really interesting result that people can earn abnormal returns because the market is not strong form efficient. So that pushed into the theory of the semi-strong form efficiency. So the price reflect all public available information. Didn't say any private information. So this information would include trading informations, is publicly available, annual reports, price released. This is all publicly available. Anyone who wants it can have access to it. Investors cannot earn abnormal returns by trading on public information because everyone have the public information. It's not like, oh, I don't know about the global pandemic, right? It's a public information. Every investor is assumed to know, right? So it's not like, when I'm buying a stock after knowing global pandemic, I behave as if I don't know, right? So I know the price is coming down. So the question is, the market will react, will analyze. Eventually, they're going to settle at the price that reflecting the prospect of the future economic situation, right? So if you only rely on the public information, you cannot earn abnormal return. Weak form efficiency. Okay, so basically the price reflects the past market information. So it's weak because they have information lag. Okay, so the price reflects the past market information, price and volume. Investors cannot earn abnormal return by trading on the market information, and technical analysis will not lead to abnormal returns. So the researchers' research result, empirical evidence really showing that markets are generally weak from efficient. Okay. Okay, that's for today. Thank you for watching. So I'm gonna stop recording.